Hello, everyone, and welcome to another edition of Formula to Success. My name is Dan Charlie, and I'll be your host today. Today's episode is a special one. Now, I don't know whether you know, but November is Long-Term Care Awareness Month, and we're going to give you some tips and tricks that are going to provide action items to help you bring awareness to clients inside of your practice around this important topic. So, very near and dear to us here at Alpine Brokerage. I know some of us have had personal experiences regarding this, and November is a great month. I mean, you really should be talking about this all 12 months out of the year, but November, there's a lot of emphasis and a lot of media around it. So with me today, I thought I would bring in the guru, the LTCi guru inside of Alpine, Mr. Josh Lipson. Josh, are you there?
Yes, thanks, Dan.
Now, the reason why I brought Josh in today, hey, Josh, how are you?
Fantastic. Yourself?
Good. The reason why I brought Josh in today is he has a real passion for this LTCi planning. He helps an enormous amount of our top producers in positioning this product with their these solutions with their clients, looking over the client's assets and portfolios to see where is the best place to insure this risk. And he's going to talk a little bit about making a connection with your client, starting the conversation, and then delivering the potential solutions to your client, all without being the expert in the field. Because Josh, you know this, advisors, they're getting hit with tremendous amount of information every single day. And they're really, a lot of them are specialists, whether it's tax planning or full financial planning or an insurance person. A lot of them are specialists in their field. So when there's an advanced topic like long-term care planning, they start to clam up. They're like, whoa, wait a minute. It's not outside of my comfort zone. What questions do I ask? How do I get this started? And, I don't want to be asked a question that I don't have the answers to, because it erodes my credibility as an advisor and may affect other business that I have with the client. So I think the moral of this story is that we're here to help. Our specialists are on your team, but not on your payroll. We're here to assist you in this line of business, to provide solutions and the words to say and a track to run on, all to make you look in the client's eye like you have all of this covered, and you may. And we're here to help and fill in any gaps that you have as well. So Josh is an expert at that. He's a real ace, a maverick when it comes to these types of cases. And I thought it would be great for him to come on today and talk a little bit about his process, what he takes the producer through. I've seen this movie, the Mel Gibson. Most of you have seen it on the stream. It's called What Women Want, where Mel Gibson ends up starting to hear the thoughts of the different women in his life. And so the reason I bring that up is I think about that with Josh, what agents want. Josh has like this superpower to be able to understand and hear what agents are thinking and give them the solution. So Josh, I hope I didn't build you up too much in everyone's mind today, but I really know that you're great at this. And I wanted you to talk a little bit about your sales process, because I think it provides tremendous value.
Sure, let's do it. Yeah, no, this is absolutely an area of passion. And I think that that if you just follow the path, clients are very receptive. They want to be spoken to about long-term care, right? They're waiting for, their advisor to have this conversation with them. So, I think that conversation starts with making a connection. And this can be something that people, that advisors just skip and run right into, let's say, the facts. But you got to take a step back. Long-term care is an emotional, thing that clients, are thinking about at home. So you've got to make that connection, make the connection with you and your clients, and then make the connection, with your clients to a long-term care experience. And you can do that simply by asking, hey, Dan, have you had an experience in your family, or a close friend, or perhaps yourself, where you were a caregiver or somebody needed care, and then let them speak, let them make the emotional connection to their experience and share that with you so that you guys make the connection. And if they don't have a story, good for them. They're one of the few that are unaffected by it. But share, your own experience, or share, that of a client. But make sure you share the emotional experience of the long-term care, experience there. And then once you've made the connection, I think the conversation or the process breaks down into three pieces, right? How do I start that conversation? What information do I need? What solutions are available? So those are really the three pieces. So, after you've made the connection by talking about something personal to them, you can pivot right into the conversation by saying, hey, if unfortunately it happens to you and you need care, who would you want to provide that care? Now, this is a powerful first question, because statistically about 55% of people want to hire a professional, which means about half want to use family. Now, all we're trying to do is get our clients to think about long-term care and their plan around long-term care a little bit deeper than they've thought about in the past. So for those who say, well, my spouse will take care of me, I want them to think about that, right? And so I might say something like, hey, that's great, but let's think about that for a minute. When you need care, you're likely to be in your 80s, right? 80, 85. Which means your spouse is likely to be 80, 85 as well. Is it realistic to think that you're going to be able to, that she's going to be, or he is going to be able to get you out of bed and on and off the toilet and in and out of the shower each day? So we're not here to dismiss their plan, tell them it's a bad plan, but we do want to make them think about that a little bit. The other thing I think advisors hear that kind of gets them nervous, well, what if they tell me my kids will take care of me? Just get them thinking a similar response, something like, hey, that's great, but think about that for a minute. When you need care, you're likely to be in your 80s, 80, 85, right? A very similar response. But think about that. That means your children may be in their 50s, maybe early 60s. They might have kids of their own in college. They're certainly, probably at their highest earning years. Is it realistic to think they're going to be able to take a year or two, however long it takes, to provide that care? Again, we're not looking to poo-poo their plan. We want them to think about it a little bit deeper than they've thought about it. So once we know, who they want to provide care, the question is, where do you want to receive care? Now, we know the overwhelming number of people will say, I want to receive care at home. And we know that an overwhelming majority of care is provided at home, but that does not mean that that's the case for every client, right? Maybe they have to downsize. Maybe, they're going to have to get rid of the second floor, or the plan is to move in with family members. And then the question becomes, does the family member know? And are they one town away, one state away, or, a country away? And that's why long-term care is a great bridge to the next generation. It's a great solution to provide clients that can be used as a bridge to the next generation, the adult children. Very, very powerful conversation in that manner. So once we know that, who you want to provide care, where you want that care to take place, the question is, what does that care cost? And you can see here that here's the national average for the cost of care in a skilled nursing facility, assisted living facility, and a home health care. But you'll also see that care varies depending on where you live. The darker states are, higher cost, care environment, and the lighter states are a lower care environment. And then within each state, right? So it's certainly the cost of care in Miami is going to be different than the cost of care, in Jacksonville. And so, we have resources available. You just have to reach out. We'll share resources available that'll let you find the cost of care, where your client is, right on your phone while you're sitting there with them. So that's really not a problem. And also, hey, listen, if they live in Chicago, but they're going to retire in Arizona, well, then I guess we should be looking at the cost of care in Arizona. So it's nice to have that tool right at your fingertips, and we can get you, all that kind of stuff. So that's really how you transition from making the connection, to how do I really get into that conversation? And then, the second piece is, all right, so now we know who you want to provide care, where you want that care to take place, and what it costs in the region that you're going to, retire and most likely need that care. Now the question is, what information do I need to collect? And I'll share another tool with you. So this is the asset identifier. We love this tool. It's one page. This is the top half. And you can see that basically we're detailing the cost of care at home, assisted living, private nursing home. You can sit with your client, pull up the regional information right on your phone, and write it in there right in front of them as you're having your conversation. It certainly can, where your client lives, so you can do it ahead of time. But it's so easy to get this information, and you put that on the top half of the asset identifier. So again, I'm going to go back to our questions to ask. And we've talked about the first three, right? Hey, now that we know you want to hire a professional to provide care, and you want to receive that care, at home as long as you can, and we know what it costs to do that, the question becomes, how are you going to pay for care, right? Now, this is the bottom half of the asset identifier. And it's basically an area where your clients are going to tell you how they would pay for care if they need it. So, hey, Dan, if unfortunately you need care, and we know you want to hire a professional and stay at home as long as you can, and that's going to cost, $5,000 a month or whatever it is locally in your area, what account would you start writing that $5,000 check from if you needed to start paying for care tomorrow? And you just be quiet and you listen to what they say. And inside the asset identifier on the bottom half, what you see here is where you're going to simply write down what they say. They may say, oh, well, we've got a checking account with $100,000, 50,000, whatever the number is. We've got a CD with 100. Everybody's situation is going to be different, but you're just writing it down. Now, we can't let them off the hook with an I don't know, because if they need to start writing a check tomorrow for $5,000 a month, what account are they going to write the check, right? That's their current plan. So you just you make them think, you listen to what they say, you write that information down, and once you have it, you put down your pen and you congratulate them for putting a plan of long-term care together.
Yeah. Josh, I think this is an amazing tool. And, we focus so much on the asset portion and getting the information into this box, what bank account, how much, because we know at the end of the day, those are going to be the assets that we're looking to use to leverage and insure against their long-term care risks. But I want to point out too that, look at the words that are actually on the page. If you go back to the asset identifier and you look at the words that are written there, it says, you've informed me that you'd like to self-insure against an extended healthcare need using the following assets. Here they are. And we will continue to review your plans to self-insure for long-term care expenses and how your changes in your life may impact your financial plans. Print and sign the client, print and sign the advisor. So I like this for several reasons. Number one, it's a fact finder that the advisor can use. But number two, it is a document that they can put in their file that says, hey, I have had this conversation with my clients, and here's the assets that they've identified that they're going to use. So in the event someone comes back to you in the future, when that person does need care, you can demonstrate that you have had this conversation, you have offered these solutions to your client, and they may have chose to go with some of those solutions, and they may not have. We know that, 100% of people don't do what we say or what we recommend. But you have something in your file that you can fall back on as the financial advisor to know that you've at least had this conversation and gone over what the plan may be. So I think it's a great tool, not only for fact finding, but also for customer, for retention in your records, to demonstrate your due diligence as a financial advisor, Josh. So I just wanted to point that out because I do hear that a lot from our elite advisors that we work with.
Oh, that's a great point. That's a great point. You always have to be having these conversations, and these are the conversations that, if you don't have them with your clients and you don't, really document that you are having them, you know, when they go on, when a client goes on claim and the children see their inheritance just, erode away on a monthly basis.
Yeah, diminish.
Yes, that is, it's never it's never your client that has a problem. It's the kids who realize, where'd my money go and why didn't you do something to
Yeah,
protect
correct.
my
So
clients?
I feel good about that. And the other thing that I would add is that we are reviewing this because it is LTC Awareness Month, but this is also something that we recommend could be instituted into your annual reviews on a regular basis. And then you're using this tool 12 months out of the year, and it becomes part of your annual review with the client. And maybe they don't do something the first year, but maybe they have that personal experience the second or the third year that you're reviewing it, and you end up reigniting that connection that we talked about. And then they are more open to having a discussion around insuring this long-term care risk as well. So I just wanted to add that also. Josh, now we've done all this great work. We've got all this information. We've come back to us here on the team. Now what do we do? What is available out there? That's what I hear from our advisors that we work with. Well, I heard there's annuities out there, and did you hear about this? And I heard this product's on the market. And I think the answer to that, to everyone on this stream today, and those advisors that we work with, is that we have all of the solutions. We have all of the solutions that are available, and those may be, depending on what happens with the client. And I'm going to let you elaborate on this a little bit, Josh, because by far you're the expert. But depending on how the client's assets are, that really depends on the solution. So there's no one size fit all for this type of issue that the client may face. And, my grandfather used to say a little bit of something's better than a whole lot of nothing. So, depending on what the client's situation is and depending on what they have, getting them to do something is way better than them just, burying their head in the sand or having an unreasonable plan that may or may not come to fruition. So, Josh, why don't you touch on a little bit about the products that are out there and what's available in the marketplace? And I know you were integral in making this infographic, which I think is wonderful, to kind of talk about the landscape of the long-term care arena and what's out there for our advisors to offer to their clients.
Sure. When I talk to advisors, Dan, they naturally want to ask about the solutions, right? That's kind of what they want to get into first. And it reminds me of something you said in the beginning of the presentation, where you talked about the fact that most advisors are experts in an area, right? And maybe this isn't it, so they don't necessarily want to be caught off guard with the question. And I always tell our partners, I say, listen, you go be an expert at knowing your client, right? If you know your client and you can come back to me and our team here, and we can talk about the client and really using the asset identifier to drive that conversation. Kind of tell me about the client, what's important to them, what do they have, how can we solve this problem, is really, how we get to the solution. And so we have, all the solutions that are available. So there's not something that, that we don't have, but really it's based upon the client's unique situation. What you're seeing here is really the spectrum of long-term care solutions. On one side, you have self-funding where the client's just going to do it on their own. And then everything else creates leverage and tax advantage. We know the advantages of actually planning for it and not using your own money. But they range from annuities with with long-term care related riders and things like that. And then we also have your traditional life insurance with your riders, right? Maybe your accelerated benefit riders like your long-term care or chronic illness rider. And then we have the hybrid solutions, the things that are life insurance and long-term care together. And then all the way on the other side of self-funding is your traditional long-term care. And that really, like we said, everything has its place. Maybe you have a client that doesn't have a whole lot of assets, but has, income, pension, Social Security, good income, and they'd prefer, maybe that monthly premium solution that we have available. So, we really have, all of the tools in a toolbox that advisors would want uh, as they have these conversations with clients and begin to present, solutions. But really, it's about having that conversation, walking the client through, the thought process of, hey, if it happens to me, who's going to provide my care? Where am I going to receive care? What's it cost? How am I going to pay for it? And then, helping them realize that they have a plan. It's to spend their money, and helping them realize that, there are better ways, that there are leverages and tax advantage ways to help, to fund long-term care, preserve your legacy for your family that you've worked all these years for. And we often get a question, Dan, we might get a question, well, what's too late? What's too old to begin planning? And we have solutions that go to age 85, right? As old as age 85. So, listen, it's never too late to have a conversation with your client about, long-term care and what their plan is. And then, we have solutions for your client, depending on their situation.
Agreed, Josh. Agreed. In our last show, the Formula to Success, we highlighted 3 different products, which I thought delivered tremendous value to the clients. The first one was the only product in the industry to have unlimited benefits still. Second was a traditional LTC policy. And third was an annuity that you did not have to be confined in order to take advantage of the chronic care benefits inside of there. Now, I know you're passionate about the uh, the unlimited benefit product. So why don't you take a minute to tell the audience out there, because we get a tremendous amount of questions on this, about that product, how it works specifically, and not in depth on the nuts and bolts of the product, but just high level on where you're seeing it as a solution for the clients, and how they're using that to ensure their long-term care expense. And then I heard that we might have a little special guest here, but I'm not 100% sure whether that's going to happen. So I don't want to let the cat out of the bag just yet, unless we know 100%. But I think it's good for everybody to hear about the unlimited benefit portfolio and how that may work. So spend a few minutes talking to us about that.
Sure. So I think that if you've had a let's say a long-term care event in your family, or you have an Alzheimer's, dementia, those types of things, you are keenly aware of the length of time that you could be on claim and need care. Those people, hands down, are extremely interested, in a lifetime benefit. But statistically speaking, more than 20% of people are going to need long-term care for 5 years plus, and the average claim time for Alzheimer's is about 8 years. That's just the average. So, there is a lot of interest in lifetime benefits, because long-term care is really the true risk to a successful retirement and legacy, when you leave, this earth. So the lifetime benefit, what I like about it is really its flexibility in how you can actually use it, and how it fits many client situations. It can be funded in a number of different ways, through qualified money, and through non-qualified annuities, through regular money that we always think of when we're buying insurance. But essentially, the product can be designed a number of different ways. But it can be single pay, it can be annual pay, 10, 20 to age 95. So there's a lot of flexibility in that. And the funding sources, as I just mentioned, are vary. But essentially, what happens is you buy a death benefit, That death benefit can be used over typically 33 months for long-term care if you need it. And once you've used up your death benefit, the continuation of benefits rider kicks in, which just continues the benefit for life. And you can't outlive it. And also, the thing that I love about it is you can cover, two lives. So husband and wife can cover themselves under one contract. And because it's lifetime, you don't have to worry about, one spouse getting sick and using up the other spouse's benefit. So it's one of the tools in the toolbox. I'm very passionate about it. I will tell you that all of our advisors, if you think about the clients you work with and you identify, a handful of clients that have non-qualified annuities, where they don't need them for retirement, after, all these years, they've done well. They don't need the non-qualified annuity. It's got lots of gains in it. That is a perfect asset to reposition into into one of these solutions, lifetime if you want, and just repurpose it and really gain some tax advantages out of it. So Dan, is that what you're looking for? Is there anything else you'd like me to dig into specifically?
No, I think that's great, Josh.
Okay.
I think that's great. Thank you very much for touching base with that. It's a very unique solution. It's not traditional long-term care. It's a life insurance-based solution for your clients, but it is one of the only solutions on the, or is the only solution on the market that provides for unlimited benefits, and it does insure both spouses as well. But since we were talking about that, we kind of segue over to another product that's available, and that is the traditional LTC marketplace. Now, I know that there has been a tremendous amount of fluctuation, I guess is the best way to put it, fluctuation in the traditional LTC marketplace. And I'm hoping that some of this interest rate changes that we've seen recently are going to positively affect some of those rate increases that we've seen come out from the different insurers. I think if they can earn a higher interest rate on their funds that they're investing, then the clients won't be so susceptible to premium increases on traditional LTC, which I think is great. So, who are the players now in the traditional LTC marketplace? I can't tell you how many people I talk to and say there is no traditional LTC, or who even has a product that is in the traditional LTC marketplace. And there are really only two carriers out there that are doing traditional LTC at the moment. And we here on our team, we really like a strong carrier, a carrier with good name brand recognition and tremendous financials. So, Mutual of Omaha is a fantastic company, a strong company, been around for a very long time, and they still have the traditional LTC portfolio. So, as I was alluding to before, what is their rating? Well, they're an A+ rated company by AM Best, Moody's, and S&P. They are A+ on everywhere across the board. Tremendous financials for Mutual of Omaha, and they've been around over 100 years. One of the things that they talk about is the tradition, the progression of the care. We talked about the conversation, how to get that started, Josh, but they didn't really talk about the progression in our last section of the presentation. And usually what happens, and what I've seen with my clients, is that it starts out with neighbors, friends, family, and then really transitions to skilled home care, where it becomes too much for the friends and family, and then they need somebody skilled to come in. And then, Josh, what happens next. Then that becomes too maybe expensive, or there needs to be too much care that they can't do it, in the home. And then we transition to an assisted living facility. And usually most of the facilities out there have a nursing home and an assisted living combined. So I think that is really the progression of care in the long-term care marketplace that we see with our clients. And you need a solution potentially that covers you throughout that entire care journey. And that's why we see Mutual of Omaha having a good fit here, because they do provide for the cash benefit. They do provide for in-home care. They will cover you in assisted living, and they will cover you in a nursing home. So very good solutions there. So what are the solutions? Let's talk about the portfolio for a second. Well, they have really two products. They have the Mutual Care Secure Solution product and the Mutual Care Custom Solution product. And really, the difference is that the traditional benefit is designed, the secure is designed with a traditional benefit design, and Mutual Care Custom is, just like the name says, a little bit more customizable and allowing for a pool of dollars that can be designed for an extensive amount of uses and premium solve capabilities. What do I mean by that? Well, client wants to have a 5-pay. Client wants to have a 10-pay. Client wants a lifetime pay. They want 3% compounding inflation options. The Mutual Care Custom Solution product provides for all of that. So, two policies, the same great features, and some of those features include cash benefit with no elimination period, low inflation protection options. Now, one thing that I'd like to touch on is that there is something called the partnership certification that happens in many states. And what that means is that you, the client, are partnering with the state to insure your risk. So they know, the states, that you're not 100%, they're not 100% on the hook through Medicaid. So in order to do that, and how the partnership certifications really work is, if you buy a long-term care policy that fits into these specific guidelines, then whatever the total pool is for the policy that you bought, the state will agree. Now, I would tell you, check with us. We'll get you the rules in your particular state. Another value that we provide here, Josh and his team. But they will shield that amount of assets that you purchase. So let's say, for example, you bought a policy, the total benefit amount is $300,000. They will shield that $300,000 of your assets for Medicaid spend down if you have a policy that fits into those guidelines. And so having a low inflation option that meets that bar but is not super expensive for your client is very important, because you get both aspects. You get a more cost-effective policy and also a partnership qualified policy. And you'll see that in one of those bullet points as well. So I think that's a great advantage to traditional LTC, which some of the life insurance, I mean, honestly, all the life insurance options. Josh, do you know of one that is partnership certified? I don't think there is one, right?
No.
So, if you want to get partnership certification on your policy, you have to use a traditional LTC contract. The other thing that's out there, and this just went through New York, and it's proposed in New York,
Washington State.
It's effective now, Josh, and maybe you can add a little color around this, is that now the states are passing legislation that are requiring individuals to have long-term care insurance, or they will be penalized. It's a tax penalty if they do not have it. So we saw a huge rush of people to purchase long-term care policies in the state of Washington when they enacted that legislation. And I know that it's on the docket, I think, for 2023 in New York and several other states.
I think it's 12 states, Dan.
Yeah. I think 12 states. So again, check with us. We can tell you, because it was a windfall of activity to the point where some of the carriers said, hey, we got to slow down the amount of applications that are coming in.
Dan, what we did see was actually a lot of movement in assets as well, because of the advisors who were not prepared to have the conversation around long-term care, who were having those conversations with advisors. Those new advisors who were solving that problem were getting a look at the plan, getting a look at the assets, the allocation. And so it's as much of a defensive thing that you've got to be, aware and prepared to have those conversations when your state gets called.
Right. Yeah. If you're not having the conversation, someone else is. And, if they're doing other lines of business, there's potential there for your client to begin to do other lines of business with that individual as well, if you're not having those conversations. You're exactly right, Josh. Thank you for adding that. All right. So what's the difference really between these two products? Well, with the Mutual Care Secure, there's a policy limit based on the benefit multiplier. There's only so much that they can get to based on the multiplier that they have. And it has a 25% cash benefit built in. Both products have that. But over on the custom, the client's buying a pool of dollars. We're purchasing the total pool, and then we're telling the policy how we want to draw that down: 3 years, 5 years, 7 years. The other thing that the custom solution has is enhanced optional benefits. So more inflation options, as I alluded to earlier, more partner benefits, and more return of premium options for the clients, because that's a big win-win for the clients. What I see the clients looking for in the illustrations that I run are the return of premium feature and the waiver of premium if it's a product or a solution that is insured on both individuals. If one of them goes on claim, the insureds like to see the waiver of premium be on both policies. It's another very, very important benefit as well. So just know that the custom solution is more custom. I think Mutual of Omaha didn't really spend a lot of money on naming these products. So, use it to your advantage. The custom solution is a more custom opportunity for your clients. Okay.
Yeah, I think, Dan, the thing to remember is, if you know your client and you can come to us and our team and, tell us about the client, then we'll be able to come to them and say, oh, based on the client, take a look at this option, and we'll talk through, the appropriate solution.
Yes.
And whether it needs inflation at 3 or 5, whatever it may be, that's really the conversation, that we're having after you've been to the client, you've talked to them, through the conversation, where they want care, what it costs, the kind of the current plan or the situation, so we can, come up with a solution. It may be traditional long-term care. It may not be. It just depends really on the client. So
yeah, and again, Josh, looking at that asset identifier that we talked about, that's really where we start to go to work, our team, and identifying, okay, what is the least impactful place for the client to start insuring this risk? What do I mean by that? Well, maybe your clients are 2 teachers and they have great pensions, but not a lot of assets. Well, then we need to be looking at certain solutions for those individuals that are designed for them to pay premiums, on an ongoing basis. Or maybe your clients have a large 401k or a, big nest egg. Then that's a more asset-based care conversation that they have. Lastly, if they have a non-qualified annuity that has a large amount of gains, we have solutions for that as well. So it's a custom tailored suit or dress to every individual that we have. Now, this slide, Josh, we talked a little bit about the cost of care. This just goes through 2020, but gives you an idea of what the national average is for the cost of care and what the increases are. And I could tell you that just like everything else over the last few years, we are seeing a tremendous increase in the inflation costs around long-term care. The cost of goods and services, everyone knows, are going up, whether it's supply chain or factors outside of our control. We know that things are costing more nowadays, and this is no different. And we're going to see a large increase in this care. And I saw another statistic out there today, and I wanted to talk about this earlier. There are 53 million Americans in the United States today that are providing for unpaid care for a loved one. 53 million. That's a lot of people. And what are those people sacrificing? They're sacrificing jobs, time with their families, other opportunities to provide this care. And so having this insurance and these solutions available to these clients, it may not just be paying for the care. It may be paying to have a normal life for the person that's providing the care, or replacing income that person normally would have gotten in order to have that care. And there's a myriad of different ways. Obviously, you can't pay, most policies don't provide for a loved one to have that type of care unless it's a cash benefit, but they could be using other assets that you would be shielding if you had a policy. So there would be assets available freed up to maybe provide for that daughter that walked away from a $100,000 job for a year or two to provide that care, or needed to facilitate all the aspects of running of the home. You know, a real live situation that I had, Josh, I had a client call just yesterday, and she was asking about a life insurance policy that's on her husband. He has dementia. And I said, "Oh, I'm very sorry to hear that." You know, she goes, "Oh, well, he's going to the nursing home." And I said, "Oh, you know what? I'm very sorry to hear that as well." Well, she goes, "No, it's just for today because I need a break. I can't do it." And I hear that a lot. And I do see the toll that it takes on clients uh, from an emotional standpoint and a monetary standpoint. And you can see some of these numbers on this slide, the cost of care. You're talking about, you know, in 2004, a private nursing home cost $65,000. In 2020, now it costs $100,000. And I'd say in 2022, it probably cost $120,000 minimum. Assisted care, home care, it was $38 and $04. You know, in 2020, $53,000, and an average annual increase of about 2%. And I can tell you that's way low for the last 2 years, way low. So some real eye-opening numbers as it relates to the cost of care. Now, inside of these Mutual of Omaha contracts, there are shared care benefits. There's also a security benefit. There's also a professional home health care benefit, full return of premium, and they will even pay for a certification for a home care, someone that's a caregiver, maybe a wife, a daughter. They will pay for a home care certification as well inside of the Mutual of Omaha portfolio. Again, this talks about their care coordinated services, what they're available to do for your clients, and the partnership benefits. I alluded to this earlier, partnership. What does partnership do? It helps to stabilize Medicaid by delaying the use of the program. Everybody knows that these programs are being stressed to the max. And so the federal government and the state governments are providing these types of partnership qualifications and benefits to try to help to stabilize Medicaid by delaying the use of the program. Also, it allows people to protect a portion of the assets. I said earlier, it shields the assets, and it is portable. Portability of partnership is available. You have reciprocal. So if you buy it in one state, move to another state, it's reciprocal to that other state. So it's a very robust program that I think people could take a lot of advantage of. I'm not going to belabor you. We could give you this details after this. You know, you could look at this. It gives you all the information. As I said, what inflation you have to add to the policy in order to provide for the partnership certification. Now, again, Mutual of Omaha has very flexible options and low cost inflation options. And here's, speaking of low cost options, they have discounts. Here's what's the premium savings. Well, if both insureds apply, they get a 15% discount. If they have a partner and only one applies, they get a 5% discount. If you get preferred, you get another 15. An association or group, 5%. If you're a producer writing it on yourself, 5%. And also common employer, another 5%. So there are some healthy premium savings available to individuals that are purchasing traditional LTC products through Mutual of Omaha. All right, what are the tax benefits? Well, some of you on this call today may say, Dan, you know what? I work in the business owner marketplace. I talk to business owners every day. What are the solutions that I can give to them? Well, what I can tell you is that if you are a C Corp, it has 100% tax favorability. And if you have a pass-through entity, it's tiered by the age. So in 2022, the amount of premium, if you're, let's just say 51 to 60, you could shield $1,690 from taxes. Write that off in the form of your long-term care premiums per partner. Now, doesn't seem like a lot, but I just did a study with 3 business owners that are converting their disability coverage into long-term care coverage. They're using those premium dollars to now that they're a little bit older, approaching age 65, they're starting to shift those dollars more to long-term care instead of disability. And so they were able to get the tax deduction up to, let's call it $16.90 for some individuals and others $45.10. So a great opportunity for you to provide some tax savings to your business owner clients through the use of traditional LTC with Mutual of Omaha. Some other things to think about. Are you eligible to pay LTC premiums out of a health savings account? Can you pay the eligible premiums from a Medicaid savings account? Yes. Yes to both of those. Are qualified long-term care benefits tax-free? Yes, they are, as long as they're paying for the qualified long-term care expenses and they meet the per diem of $400 a day. Nothing over that. That's 2021. I think we're going to see an increase in 2022. In 2023. So, all right, let's transition to underwriting. Here's the product solutions available. Again, I said that you have the custom solution as well as the secure. I think what you need to take away from this is that people do qualify for long-term care, believe it or not. You know, Josh, I would tell you that when we talk to advisors, a lot of them come back and say, well, no one qualifies for this anymore, right? Would you say that's something that we hear a lot?
Yes, that's correct. Yep.
No one qualifies for this anymore. Or, you know, they're going to go all through my client one way and they're going to never approve them. It's just something that people apply. They usually don't get approved. So, you know, we have field underwriting tools available to us that, Josh, I know you use every day with advisors that allow them to kind of see behind the curtain of what Mutual of Omaha is going to insure from a risk and what they're not. That way, it cuts down on time and unnecessary declines for your clients. We know declines are not a pleasant experience. No one likes to get told no. Especially after you've had the conversation and we've identified the asset and we've done all of the due diligence and the client's excited about it. The last thing we want them to be told is they can't have something they were looking forward to having. So Mutual of Omaha has great underwriting tools available. We've seen placement ratios in the 70 to 80%. And you as an advisor will know exactly what your clients are looking for and what Mutual of Omaha, more importantly, is looking for when it relates to medical underwriting. So get with us. We can get you these guides. You can look through it. And I would also tell you, if you have a client and they have a certain health issue, give us a call. We always are happy to do the got a guy scenario. Hey, I've got a guy, or I've got a couple, I've got a gal, and this is her situation. She's on these medications. She's got this health situation. We here at Alpine, you know, we're, again, on your staff, but not on your payroll. We will go and do that work for you so you don't have to do it. So with that, I know I took some of the thunder away from Mutual of Omaha just to get started, but I think that special guest has arrived, if I'm not mistaken. It's like, you know, when you hear, you know, some of you out there that may celebrate Christmas, I know we have a lot of different ethnicities through our agent database, but some of you, when you hear the rooftop, you hear the hooves on the rooftop, you know someone has arrived. And I heard through the grapevine that John Gibbons from Mutual of Omaha actually heard us on the stream and was able to dial in. So, John, are you there?
I am here. Can you hear me?
I can. Now, John, we had our times a little mixed here. But I went ahead and got started on the presentation, and guess what? I did all the boring stuff, so I was able to cut that out for you. And
okay.
We were just talking a little bit about the underwriting available at Mutual of Omaha and where their product fits as far as you know, the traditional LTC marketplace, and you know the fact that you have to have a strong name, and the differences between the secure and the custom solution. But, you know, I'm glad that you heard us on the stream here and was able to pop in. Why don't you take a few minutes to introduce yourself and tell us a little bit about Mutual of Omaha and your position there, and really what you're seeing in the marketplace. And more importantly, as I know we're going to get to that at the end of your presentation, what Mutual of Omaha is getting into and helping advisors as it relates to long-term care awareness month.
Sure. Am I able to hit present my screen?
You are.
Share screen, share. Let me pull this up.
I love it when the carriers hear us on the stream and then jump in, and that's what's great about this platform that we're using. I did do some of this, John, so you're probably going to do a lot better than I am. Because
Okay, I know you did all the planning part.
this is what I like to call your bailiwick. You know what I mean? I mean, this is what you do every day, all day long. I'm helping advisors, and I come to you as a resource, you know, up the chain for you to provide these solutions for us and our advisors. So I appreciate you being on today and helping us kick off Long-Term Care Awareness Month in November. I think Long-Term Care Awareness Month should be every month, but we have particular emphasis on it in November. And one thing I didn't talk about is November and December. And I think, John, you were the one that told me this. There's so many conversations that happen around long-term care because it's when families get together. It's when you're sitting at the table at Thanksgiving, you say, you know what? You know, we need to talk about this because, you know, we just celebrated mom's 80 or 82nd, 83rd birthday. And, you know, we all know the death rate in the country, you know, is 100%. No one ever makes it out. So, you know, at some point, we're going to have to address these concerns with our own family members. And it brings it to front of mind because you're with all of your family. So that's why I think November is a perfect month for a Long-Term Care Awareness Month. And there's no better place or no better person to talk about it than you, John. So go ahead and take it away, bud. And I appreciate you jumping on our stream.
I'm glad to appreciate the time. And you're right. I think statistically there is a lot of bump right after the holidays for that exact reason. They get together as a family. They see mom or dad getting ill, and then they start talking about we better take care of this for ourselves. So, you know, our kids don't have to be caregivers to us like we are doing with mom or about to do. So, absolutely. And obviously, this is important product in retirement planning. And I know you've just covered all that. I'll go through the product portion. And what I'm going to do is I'll use our product as a guide for the industry as a whole. And you have numerous options out there that Dan and the team can give to you. So we've got secure and custom solution are ours. And both of custom is the one we lean towards. And a lot of different reasons, and I'll hit that. But both products happen to have these items right here.
Yeah. Now, what would you say would be the statistics on how much comes through as custom?
Well, see, I don't know right now because it used to be before we changed our product last year, Secure used to be the lead product, but we refreshed our pricings and redid some things on Secure. But I'm going to guess 60-40. If you ask me, it should be 80-20.
Yeah. Yeah. I mean,
90-10.
I know we almost exclusively show custom.
Yeah.
But I think, and I did go over this slide a little bit, but I think really you could dial in where's a scenario where we would be looking for secure over custom? What would be something that we would be looking at? Or is it just that custom is by far the newest and most innovative product in your portfolio, and we should really just be looking at that first? What's your take on that?
You should just be looking at custom. The premiums are very close, usually within $150. Sometimes custom's even less expensive and has things built in. So when we repriced this, custom just became a better product. And there's really even no need for secure, in my opinion, at this point that I can think of. So,
you know, coincidentally, I ran secure by accident for a producer, and then I quickly ran custom, and the producer says, "Well, what's the difference?" And you know, I had to contact Caitlin, your great counterpart, to really understand what the difference was, because I only really quote custom, but I, you know, I think just in general speaking, custom is a little bit more flexible than secure. Would you say?
Correct. Custom has more options and has some things built into it.
And then I know secure has the benefit multiplier, and then custom has a pool of money. So, you know, is that a real difference maker when it comes to the policy? And how does that work as well?
That would make a difference if you're trying to get beyond 5 years. So custom secure just says 2, 3, 4, and 5.
Correct.
Now I have a 500,000 pool of money. I could theoretically, if I have $5,000 a month benefit, could go 8 years. So it's going to depend on my monthly benefit on how many years I can go out with custom.
Understood. So if you want something more than 5 years, you're probably leaning more towards the secure and building that.
No, custom.
Oh,
Custom.
with custom. I'm sorry.
Custom, we go farther.
Building that pool of money because you can stretch it out longer than 5 years. So I guess that would be the key differentiator.
Yeah. So let me do a time check too. How much time do we have?
Oh, just keep going. We're live and in the flesh. We got plenty of people on here.
Okay.
So we got a great audience. It's a great show. So keep it moving. Okay. We got plenty of time for you, John.
Okay. I got a feeling maybe with the time change or the Central Time, Eastern Time, maybe we did this. I had this backwards, but sorry. Let me hit salient points here. So cash benefits a huge deal. I can use this immediately. I can pay my wife cash. I can pay my daughter. It's capped at $2,000 to start with, can grow with inflation, 25% of my benefit. This is used a lot. This is a huge deal. All right. We have monthly benefit versus some competition. We'll have daily, big difference between the two. And our calendar elimination period versus some carriers have what's called service days. So you got a 90-day elimination period, and it's service days, and you're getting care every other day. It's going to take you 180 days to get through that. Ours is flat 90. All right, here's some of the differences like you were talking about. So secure 2, 3, 4, 5 years of coverage. Custom, I can go with that pool of money. Mm-hmm. Both are capped at $10,000 a month. Mm-hmm. But you can see down here, elimination period, I only have 90, 180, 365. Secure, I've got 0, 30 days, 60 days. Now, in all candor, I would not go at 30 days.
And why would you say that, John? Is that because Medicare, theoretically, Medicare would cover the first 30 to 90 days, depending on what the nature of the illness was that happened to the insured, or?
Yeah, possibly. Or the other thing is it's just expensive. And I don't think that's what people are worried about. I'm trying to keep my premiums reasonable. They're worried about the next 2, 3, 4 years, not the first 90 days, in my opinion. So I don't add 0 day. You could potentially add 0 day for just home care, but I also don't even lean towards that unless somebody asks for it and wants it. I'm trying to keep these premiums reasonable.
Yeah, and I alluded to this a little bit earlier in the presentation. You know, a little bit of something's better than a whole lot of nothing. So premium tolerance is important with clients with these policies. Obviously, as advisors, we want them to be insured, and we want them to have insurance that is meets their needs. But if they can't pay for it and they're going to let it lapse or let it go in a couple years because of the premium tolerance, well, it really wasn't worthwhile going through the process, up front. So, premium tolerance is important. And I think you're right, John, to keep that premium lower. Clients usually have an emergency nest egg somewhere, whether, at a very minimum, it may be, I hate to say it, but a credit card. Or some of them have savings, or some of them have 401k or an IRA that they can dip into to meet the needs of that first 30, 60, 90 days. But you're right. Once we start talking about 2 years, 3 years, 5 years down the road, they say, wow, all of that's going to be exhausted. Now this is what I'm really looking for. So I like that strategy of keeping the premiums lower. But as I alluded to earlier, keeping it partnership certified, qualified, and being able to kind of meet both of those needs at the same time.
Yeah. We have waiver of premium built in right here. I go on claim. I'm not paying. All right. Now down here, I have joint waiver of premium where if I have, my wife and I both buy together or my partner, I go on claim. They don't pay either. And that's inexpensive. I do add that. That's one of the few riders I'll add. It's only like $100, $150 a year.
You've actually made that recommendation to me on a few occasions, the joint waiver. And I alluded to that in our presentation that, my wife or my husband goes on claim. The premium should be waived with that rider. And that's a great rider. And it's not very expensive either.
Another thing is inflation protection. Secure only has 3, 4, and 5. I can go down to 1 to 5. So I'll use 2% as one of the first triggers that I'll pull if I have premium sensitivity and I'm trying to keep this reasonable, I'll drop to 2% inflation. All right. Secure doesn't have that option. I can go down to 1%, 1.25, 1.5. I all these flex options, but also over here, inflation duration. If I have a 60-year-old, the average claimant is age 79. So let's round up to 80. So if I have a 60-year-old, I'm going to do my inflation for 20 years. That's going to get them to age 80. That's going to save like $1,000 to $1,500 in my premium annually instead of having lifetime inflation. If I got a 65-year-old, I'll go to 15-year. Big difference. You got to pull those triggers.
Would you say that you really try to match it up to age 80 if possible?
Yes. Yeah. I won't do it.
So take your client's age, subtract that from age 80, and that is the amount of inflation that you need. If they're a lot younger than that, then you're probably going to need lifetime. If they're in their 50s,
correct.
But if they're in their 60s, you can get away with 20 or 15, and if they're buying it in their 70s, maybe even 10.
Yeah.
Great.
Here's one of the biggest reasons also. My internal Caitlin and I utilize custom. The inflation buy up and buy down is built into the policy. So what happens is you want to talk to people in their 50s, right? And you're going to hear the objection, I've got kids in college. Now, so here's what we're going to do, Mr. and Mrs. Jones. I know you understand you want to do this while you're younger, while you're healthy, and it's less expensive. So we're going to start you at 1% inflation to make this affordable right now, which is going to save like $3,000 a year rather than doing 3% inflation. You're telling me at age 58, first kid's out of college, a little bit of extra money. Well, we can, on your policy anniversary, up your inflation to 2.5.
Without showing insurability, without doing anything.
Correct.
How does that work, John? Do they fill out a form, send it in?
Have a form, send it in, give us 30 days notice, preferably 60 days, and we can make that adjustment on any policy anniversary. You can go up for the first 20 years or until I hit age 75. I can always go down. All right. I get to age 61 and the last one's out of college. And we go, all right, now we're going to up it to 3.5 and play a little catch up. I get to age 80, I'm overinsured, I can drop it down. Here's the other thing. If I'm age 70 and I have a stroke and maybe I'm not ready to claim yet, but I'm having issues, I know this is going to be a claim soon, I can buy more coverage. I can go from 3% to 5% and without having to show insurability. So that's a huge option too. So this is a great selling tool, whether they use it or not. It's like peace of mind for them. So this is this is built in the custom.
Premium, some level of premium control down the road after you purchase the policy. You're not locked in. Correct. I guess you would have, you'd have whatever the low water mark would be 1%, and the high water mark could be what, John? What's the high water mark? Up to 5%?
5%. Yeah.
Up to 5%. So you've got that range in order to control your premiums. Maybe if you're younger, you're scaling up. And then as you get older, you're pulling it back maybe a little bit. Or you find out that you're underinsured and you juice it up to gain some more coverage over a short period of years.
Yeah.
Wow, that's a great point.
All right. A couple things here. With traditional long-term care, a shared plan is common. So I buy a policy, my wife buys a policy. I can connect them. 4 years, I'm a big on 4-year policies. 4 for me, 4 for my wife. I can connect them with a rider, and now it's 8 years to share. Because we as males think we're invincible.
Right.
That we're right.
And we're going to drive our motorcycle off the mountain at 110. That's what we're doing.
Yeah. So, Mr. Jones, whether you use this or not, there's coverage here that if you don't use it, your wife can come over and use yours.
And if I'm not mistaken, John, you have to leave 1 year left. Is that correct?
If I'm alive, I can only come over and have to leave 1 year of yours. If I've passed away, I can use all of it.
Okay. Got it.
All right, so that's a huge deal. That's the rider for a couple I'll use every single time unless I'm doing return of premium. I can't do both together. All right, next is security benefit, and this is unique. You get the question all the time, I've got one unhealthy spouse, do I have any options? Well, you do. So my wife and I apply, and she gets declined. Or like my mother who had MS is ineligible to apply. So on the healthy one, on my healthy policy, I add the security rider. It costs 60% more premium, 60. But what happens is that's still less than me and my wife together. When I go on claim, let's say at age 80, I'm at 10,000 monthly benefit and I'm using all of it. I get 60% of that cash. I get another 6,000 on top of my 10,000 to do whatever I want. I could go buy a new car if I want.
They call that rum and cigarettes money, John.
Yeah, there you go. Yeah. But yes, but
in all serious, it's designed to provide security for someone that may be depending on you.
Correct. And if they don't need care yet, just bank it. So end of 3 years, you got $210,000 sitting in the bank.
Yeah,
right?
I mean, for example, I have a special needs daughter myself. That's my own personal story. And, that security benefit could provide for things that I would be normally providing for her when I need the care. So many different uses I can see for that.
Yeah. And then full return of premium, we have that age 60 and below, because one of the objections with traditional is what if I don't use it? Not everybody has a concern with that. Most insurance is like that. But if it becomes an objection, age 60 and below, we can add return of premium. I think I have a slide in here. I'll show an example, but and we're very competitive with that. And then the last thing for us on here is, on this slide, is I can make our product look like indemnity. So if my caregiver, it can be a neighbor, a friend, the cleaning lady, it can be cannot be a family member. If they go get a certification as a caregiver, and it's not a nursing degree, they went to night school 3 nights, they got this piece of paper that says I know how to care for somebody, you can pay them cash. And you pay them what you want. An agency might charge $50 an hour, and maybe you pay them $25, so your money lasts longer. Maybe it's because of somebody so that's a big deal with ours, that you can do that with your entire benefit if they get a certification.
And I'd say the other nice thing about that too, John, is that it's somebody that they know as opposed to a stranger. Where if they're going to an agency, they're sending somebody in that they don't know.
Yeah. Now, another benefit of traditional policies that asset-based don't have is partnership benefit. So I can protect some assets. Now, what this means is if I buy a pool of money, long-term care, I've got my $300,000 pool of money with Mutual of Omaha, and I go through it, and I'm out of money. Now I have to go to my money, and I have a $500,000 net worth, including my home equity. I can spend down $200,000 of that and stop when I have 300 left, protect that, and leave it as a legacy for my adult children. If it was a 200,000 pool of money, then I could protect 200,000.
Yes.
And it's to get that. Most states have it, not all. All you have to do is design your inflation protection appropriately, and it automatically is part of the policy.
And this is kind of what I was talking about earlier with the customized inflation options. You can flex it down to 1% to qualify for the partnership program. If you're a certain age demographic, you can see there 1% pretty much qualifies for the large bulk of the states. It looks like some are 3, but most are 1. And you can keep your premiums at lower. And with your premium, with the inflation options that you have to raise at any point, you have that lever that you can raise that up as you get older and maybe need that, or to keep up with inflation. I alluded to that earlier on the call. Inflation is a lot higher than it was just a couple of years ago. I don't know if anyone's noticed, but we're paying a lot more for the goods and services that we use every day. And long-term care services are no exception to that. So this is a good way to get people started, keep a good premium tolerance, get them partnership certified and qualified in order to protect those assets. And then, hey, down the road, if they need to to juice it up or bring it back down a little bit, they can do that as well.
Yeah. Yeah. And this is a bigger deal for your blue collar, but also some upper middle class. I could tell you, I grew up in a blue collar family. As I said, my mother had MS. My dad had to be the caregiver for his whole retirement. We had a conversation one time before he died. He realized at one point that when he passes away, we would have to use a home equity to care for her, and that money would be gone. And he wanted to leave that as a legacy to me and my 4 sisters, because that's what his dad, as a blue collar person, did for he and his siblings.
Right.
He
The
was
house
devastated.
was it. The house was it.
Yeah. He was
that's what he passed
devastated. He
on.
couldn't do that. Yeah.
Yeah. That's
So this is a
unfortunate.
big
I'm very
deal.
sorry to hear that.
Most carriers offer some type of partner couple discount. So do we, 15%. If only one applies, there's approved 5%. Do not offer our preferred health. Only 18% of the people get it. Let it be a surprise. You don't want to
Under promise and over deliver. Under promise and over deliver.
Now, you as advisors should have it on yourself, because your clients may ask you at some point, what kind of coverage do you have? We give you and your spouse a 5% discount. All right, here's a big one.
Yeah. Now, just back up one more slide, because we were talking about this. The common employer, how many do you have to have on the common employer to get the 5%?
To start, 5 employees or more. And then you
Okay.
can do onesies after that. And then you get a 5% discount for the employee and the spouse.
Okay. That's good
Yeah.
information.
Yeah. All right. Tax benefit. C Corp. This drives me nuts, Dan, because there's so much opportunity here for agents to go to their business owners, especially now it's LTC Awareness Month. Go to your business owners, say, hey, are you aware of the tax favorability of long-term care? No, but we need to have a conversation. C Corp. If I'm a C Corp, 100% write-off for me and my spouse or partner. Does not hit my income. Benefits are still tax-free. Huge deal. Why wouldn't you do it? For pass-throughs, so LLC, that's not a C Corp, S Corp, partnership, sole proprietor, I'm selling widgets on eBay. I have age 51 to 60 right here. It's tiered by my age. I get to write off $1,690.
Mm-hmm.
If my wife's the same age bracket, same for her, that's $3,890. Why wouldn't I do that? Or if I'm 61, 62 years old as a business owner, it's $4,500. My wife's the same age, it's $9,000. So they need to be proactive. This is a huge deal that not taken advantage enough.
Well, we always talk about finding the premium, even with our life insurance sales here at Alpine, let's find the premium. Where are we going to find the monies to pay this? And whether you have an individual that owns a landscaping company or a Fortune 500 company, they're all looking for premium deductibility. We get that question quite a bit. So this is a way that you can go to them and say, this product is, life insurance premiums traditionally are not, but this product is. And I would even venture to say the disability premium is not, but the long-term care insurance is. Because I have disability on myself through our business here, and that is included in my income, except for the business overhead expense. So, they get that deductibility, and we find some premium dollars that then we can allocate. And listen, a $4,500 policy on a 61-year-old, I mean, it's a policy. We can structure a policy for that $4,500 in order to make that, again, something is better than nothing. And maybe they see the value in the insurance and they want to pay a few extra thousand in addition to that. And then we've got a very nice policy that we're providing for those individuals. And that's them and the spouse on that as well.
Yes. Yep.
Well, that's great information. Thank you for that.
Yeah. You can also use HSA money, SMA money. I think you touched on some of the underwriting. Big thing here is do your field underwriting, ask questions. We have a great underwriting guide that you can have electronically or carry the booklet with you, and look up certain ailments, medications, height and weight chart, save yourself a lot of heartache. Most strong agents in long-term care lead with field underwriting. First thing they go through. They're not going to start going through anything until they do the field underwriting.
Well, and as I talked about earlier in the presentation, we've created a connection with the clients around something in their life, maybe a loved one that needed care, maybe a client that we have that needed care. So somehow we made a connection. We went through the entire process of uncovering the assets that they were going to use to insure this risk, how they were going to insure it, the need. We've got the application process started. The last thing that you want is to have something bad happen in field underwriting that then turns around and, we have to tell the client they can't have something that we've been gearing them up to look forward to having. That puts a bad taste in their mouth. So, doing the field underwriting up front, again, big shout out to us. Call us. We can get in touch with Caitlin and John and find out if this is a risk that Mutual of Omaha has an appetite for, or it may be something that maybe is not even an issue, and you may think it's an issue, but it's not.
Right.
So either way, give us a call and we can get those answers relatively quickly. With medications and a little bit of health history, we could probably get you some guide rails as long as that information is accurate.
And then with us, if age 60 and above is going to get a cognitive, but the bigger thing here is they have to have been to the doctor in the last 24 months, physical with full blood work. So, or we will reject the application. So 60 and above have to have been to the doctor in the last 24 months, full blood work.
Mm-hmm.
We have great marketing pieces that Dan and his team can get to you. We have an e-app. This consumer video is good. It's 2.5 minutes long. Some agents will send this to their client before they meet with them. It's actually something you could potentially send out proactively. Usually it shows the slide, but you can send proactive because it's Long-Term Care Awareness Month. You may want to email to your clients or whatever. And the key here, so here's the last slide for me, is you've just invested over an hour of your time. Apologize for the time change difference or whatever mess up here, but call to action. You invested this time for a reason. Now do something with it. Like, here's your sweet spot, age 50 to 65. You can go above that and below it, but that's your sweet spot. Look at your business owners. All right. And target them, especially with Long-Term Care Awareness Month. Single females in their 60s and 70s. I guarantee you they're worried about this, right? They're thinking, what's going to happen? They don't know they can get it. I mean, you can do your field underwriting, especially at those ages, but they can get approved. And then don't forget about your wealthier clients, because they will buy this. They get the concept of other people's money, leveraging, taking a small piece of that pie to cover all of it or a good portion of it.
Yeah, I don't know whether we still have Josh backstage or not. Josh, you're there. Hi, how are you, Josh? Welcome back to the program.
Doing well.
Good. So, I just want to close it out here and thank both of you for your time today. I know, Josh, John had in his last slide, be proactive, not reactive. And I think that kind of goes in line with everything that we've been talking about earlier in the presentation. We want our advisors to be proactive and start that conversation with our clients. And again, that conversation really gets broken down into 3 parts. How do I start the conversation? What information do I need to get from my clients, whether it's for field underwriting or for financials, using our asset identifier? And then what products are available out there? What products are out there to help solve the needs of my clients? And we have a myriad of those products out there, but traditional LTC is definitely an answer. And just like to thank all of our guests today. John, thank you so much for being here. Josh, really do appreciate you jumping on. Josh, the LTC guru here on my team. Really want to thank you and all the advisors out there that are presenting. Hope you have a great November, making LTC Awareness Month impactful inside of your business and, more importantly, for your clients. And we look forward to seeing you on the next edition of the Formula to Success. Thank you all. I'm Dan Charlie. Have a great day, everybody, and we'll see you soon. So thank you so much.